Okay, folks. Okay, so I'm going to start today's class by kind of completing a few loose ends from the syllabus about grading, quizzes, etc., which are probably in the top of your mind. And then we're going to start on packet one. So if you have packet one, great. If you don't have packet one, it's okay. You know, you're not going to die. You're going to see the slides. You can download them when you get a chance. But starting in today's session, we're going to start on packet one, and it's going to take us probably through week 8 or 9. There will be a packet 2, which you can download when you get a chance. So I described this class as an applied corporate finance class. And I want to make true on that promise. When I first was given this class to teach, it's a collection of topics. You do different case studies, different companies in each class. And I've never understood the pull of that approach, because you talk about a different company in each class. You're trying to relate to what does this company do? Why is it different? Instead of doing that, here's what I'm going to do. I'm going to take 6 companies, and they're going to be lab experiments that I will run through all the way through this class. And I'll go through the 6 companies because it's going to give you a sense of how I've structured this class. The first company that I'm going to talk about all through this class is Disney. Why did I pick Disney? Because everybody kind of knows what Disney does, right? I mean, if I'd picked Alcoa, you'd be struggling for the next 15 weeks saying, what exactly does Alcoa do or Navistar do? At Disney, we kind of have the Mickey ears. You've seen, you might not be understanding how complex the company has become under that heading, but I picked Disney, large US entertainment company. The second company I'm going to use as my lab experiment is a company called Vale. Heard of Vale, anybody? What does Vale do? It's an iron ore mining company. It's a mining company with iron ore being its lead. It's the largest iron ore mining company. And it happens to be incorporated and traded in Brazil. Notice the words I use, happen to be. Okay. I think the world is composed of multinationals that through the accident of history happen to be in some part of the world. Coca-Cola is not a US company. It's a multinational that happens to be in the US. But I picked Vale for a very specific reason. I wanted to get as different from Disney as I could get, right? Here you have a mining company, an emerging market company, and a company that used to be government owned. And that's going to come into play when we look at how Vale approached. It used to be entirely owned by the Brazilian government. The Brazilian government still has a golden share. You know what a golden share is? It gives them veto rights over big decisions that Vale makes. So Disney, Vale. Let's keep going. Tata Motors. For those of you familiar with the Tata Group, it's one of India's oldest family groups. Perhaps one of the best regarded family groups in India. Tata Motors happens to be one of the 116 companies that are part of that group. 70 are privately owned, but Tata Motors has been around for 60, 70 years. It used to be a mass market automobile company. It's a used to be, because as we're going to talk about in this class, in 2009, they made a pretty momentous decision that changed their characteristics of the company. Anybody want to tell me what that decision was? What did they do? They bought Jaguar Land Rover from Ford at a bargain basement price. And overnight, the company changed from being a mass market Indian automobile company to having a big chunk of its revenues from a global luxury, an upscale, I don't even know what to call a Land Rover, but whatever that company is. And I picked Tata Motors for a different reason as well. Not only did I want to bring in an emerging market company, I wanted to bring in a family group company. Remember, in much of Asia and parts of Latin America and even Europe, companies really are parts of groups. You're saying, so what? Because if it's a family group company, there's a family on top of the company. There are 110 companies. They might all be publicly traded, but there is another interest at play, right? The family's interest. And sometimes, lots of times, the family interests are going to dominate what's right for that specific company. And we're going to talk about how that plays out in decision-making when you're a family group company. The fourth company I'm going to value is a company called Baidu. It's a search engine. How many of you have searched for things on Baidu? By the show of hands, I can tell where you're from. You've searched for things, and where are you from?
I'm Chinese from Canada.
Okay. But if you go to, I remember the first time I flew to China. I haven't gone to China that often. I take off, it's a long flight. I'm working on my blog post. I land in China. I get on Google Blogger to check, what's happening. It's disappeared. So what the heck happened while I was in the air? Did a $1 trillion company go into thin air? The fact is, in China, for the longest time, unless you used a backdoor to get in, you couldn't search on Google. So Baidu is the second largest search engine in the world. It has 75% of the Chinese search engine market. And I picked Baidu because you had to bring in China somewhere into the picture. I wanted to bring, and what makes Baidu a strange Chinese company, and perhaps not so strange, is while it gets almost all of its revenues in China and its headquarters building is in China, guess where it's incorporated? It's incorporated in the Cayman Islands. And it's actually not the company that's incorporated. It's a shell company incorporated in the Cayman Islands that trades on the NASDAQ, that has an operating agreement that is technically legal. So we're building things on top of more things, technically legal with the parent company in China. But the Chinese government has turned and looked the other way. So when you buy shares in Baidu, you're buying shares in a Cayman Islands company that owns nothing. But it's got, so I want to talk about what happens there when you're a shareholder in Baidu. What exactly do you own shares in? You don't own shares in the Chinese operating company. You own shares in this Cayman Islands company. You can do all the dances you want about who the directors are for this company, but the operating company is what matters, right? Now, Baidu's structure is not unique. Alibaba, also, when it first started, was listed, was a Cayman Islands company, just like Baidu. So I want to talk about how companies sometimes use structures to keep away. It's not just corporate governance and other issues as well. The fifth company I'm going to value is Deutsche Bank. Why? Because I like horror stories. This company, those characters in horror stories, usually it's a teenager. There's a basement in this house that's creepy. The basement door is closed and there's noises coming from the basement. Let me ask you a question. You're in a creepy house, there's a basement door, there are noises coming up, maybe a chainsaw noise. You don't feel tempted to explore, right? But this teenage character will open the door, go down, and terrible things will happen. Deutsche Bank is very much like that character. For the last 15 years, it hears noises in the basement, it goes and explores, and it comes out all bloody saying, oh, we don't know what happened. But it also gives me a chance to talk about financial service companies. Financial service companies are strange beasts. They're strange beasts because they're not like traditional companies in terms of the choices they make. They're constrained. They're constrained by regulatory requirements that are fairly stringent on how much you can borrow, how much you can pay in dividends. And I want to talk about how does corporate finance work there? How do you pick projects? How do you fund those projects? Those 5 are all publicly traded companies, different parts of the world. The 6th company, I'm going to value is not a company. It's a privately owned bookstore in New York City that I've changed the name on. I'm going to call it Bookscape. It's a small privately owned bookstore. And I'm going to use that to illustrate how are things different. If you're the owner of a small business, how do investment decisions work out? What are the constraints you face when you look at funding decisions? I want to bring in a small private business. The reason I picked these 6 companies is to show that corporate finance principles remain the same, no matter where you are in the world, no matter what kind of company you're looking at, whether you're private or public. But the challenges, the estimation challenges might be different. The constraints might be different, and we can talk about what those are. So that is basically how the class is going to be structured. So everything we do in the class, I'll apply on these 6 companies. When we talk about measuring risk, I'm going to measure risk at these 6 companies, come up with hurdle rates. When we talk about the right mix of debt and equity, I'm going to take each of these companies through the mix. And they're live lab experiments, right? So while the numbers I might use might reflect what Disney looked like in 2013, there's no choice but to talk about what's happening at Disney right now. And interesting things are happening at Disney, right? And again, I'm using the Chinese version of interesting, which is, of course, may interesting things happen to you, and interesting things are happening to Disney. They've had a CEO come back. It's like a quarterback coming back and replacing somebody who just signed on 3 years ago. You got Nelson Peltz saying the company needs to be, it's at the center of a storm. We'll talk about what put it there and where it might go next. Each of these companies is a live lab experiment. So as we go through, I'm going to update some of these stories that this is where the company is. Why do you think it's here? What should they do next? Now, along the way, you're going to be tempted to just sit back and say, hey, he's doing the work. Let me just sit back. And I can't let you do that. So here's how you're going to come along for the ride. There will be a case halfway through, and it's not going to be a Harvard, but it's a case that I write every year as a fresh case. And I keep thinking of something interesting to put out. It's a case that will test you on assessing an investment. So, I think it was 4 years ago, it was an Apple iCar. I made an electric car that Apple is going to make. I'll give you the information and say, would you as Apple take this project or not? So you're going to get that case. I haven't written it yet, so you can't get it right now. In about 3 weeks, and you'll have 3 weeks to work on. It's a group case. It's 10% of your grade. Again, just to check to see whether you can do investment analysis. But the big project you're going to be doing all through the semester, in fact, it already started on Monday, even though you didn't know about it, is essentially you've got to pick a company and do what I do with Disney and Vale and Baidu and Deutsche Bank, which is ask all the corporate finance questions. Do they take good projects? Do they fund themselves right? And essentially that project runs all the way through. It's a group project. And I'm going to impose a couple of constraints. One is in terms of group size. I think you need at least 4 people for a group to have enough to go around as a group. I'm going to cap it at about 7, but if you can convince me that you can live with 8 people in your group, hey, it's your problem. You can deal with it. I'm okay with that. So 4 to 8 is the group size. Each of you is going to pick a company. Let me repeat that again. It's not the same number of companies, no matter what your group size. So if you have 8 people, you have 8 companies. You have 4 people, you have 4 companies. And those companies have to be bound together by something in common. In fact, when I say something in common, I don't want you, if you're a group of 6, to pick 6 steel companies in the US. You're going to be bored out of your wits. This is a project where I want you to talk about diversity of companies. So if you want to pick a theme, make it a broad theme. It could be transportation. In your transportation, you can have 3 airlines, a couple of automobile companies, and throw Uber into the mix. It can be entertainment. And entertainment, you can go all the way from businesses like Netflix and Disney to gaming companies. In fact, if you really want to break the mold, you can say, I want to pick sinful companies. We live in a world where companies are good or bad. I want to pick the worst among us. I'll pick a fossil fuel company. After all, we've decided that they're evil. A gambling company, those guys are terrible. How about a tobacco company? They've been branded now for 40 years. So when I say a theme, it can be very broad. And basically, it's a theme that ties together. And the only reason I put the theme in is there's something that they all have as a macro variable that's driving them. But really, this project is about talking about differences, not about commonalities. Now, some of you are probably saying, I've never done something like this before. How the heck am I going to do it? I'll do the dirty work for you. I'll give you the spreadsheets. I'll give you the data. I'll give you links to data. In fact, I've actually got a spreadsheet, which I won't share with you, where if you enter the numbers for a company, it does all the numbers for the analysis automatically. Maybe at the end of the class, I'll give it to you and you can take it with you. This is not about grinding out numbers. It's about reading the numbers. It's not about saying the optimal debt ratio is 40%. I'll give you the spreadsheet that does it, but tell me why the optimal is 40% and what the company is supposed to do with the 40%. Get ready for a world where that part of the work, the mechanical part, is going to be done for you, not even by another person, by a computer, AI, whatever. And anybody can do the mechanical stuff. It's being able to read that I want to push you on. So those will be the projects. So 10 and 30, that'll give you 40% of the grade. What about the other 60%? There will be 3 quizzes, and they're listed in the calendar. And they will basically, the quizzes themselves are non-cumulative, which means the first quiz will cover sessions 1 through 8, et cetera, et cetera. But that's a bit of a lie, because if you really don't get the first third of the class, it's going to be very difficult to just say, I got sessions 9 through 17. But in terms of focus, the quizzes will cover segments of the class. They're each worth 10%. And I'll give you a few pointers on what happens if you miss a quiz or not in the next page. And there's a final exam, which is worth 30%. All of the quizzes and exams are open book and open notes. And I know we're in 2022, not 2002. So for many of you, your notes are going to be on an iPad, even on a laptop. You're okay. That's fine with me. To me, that counts as open book, open notes. What I don't want you to use are spreadsheets to grind through. And I'm doing this for your own protection. Because if you start, I could make these quizzes spreadsheet friendly. But then I'd write a very different type of quiz. And trust me, you don't want to see that quiz. My quizzes are not about 4 decimal points. They're numbers that you can usually do in your head. So that's not the test of the quiz. It's being able to take the numbers and work with them. So just a few things about the quizzes. And you could read I won't go through the entire list. If you have to miss a quiz, you have to let me know before the quiz. Almost everything I do is in reaction to people gaming the system. I know you're not that type of person, but I'm talking about that other person who's that type of person. I've had people, when I first started, would take the quiz, and if they did badly, remember, I have a class of 250. I have no idea who's in the room or not. So they use this as an option. They take the quiz, they do badly, they put it into the backpack, and they say, I wasn't at the quiz. So to prevent that, you got to let me know before the quiz that you can't make it. And if you're not going to make it, I'd like you to at least make up a good reason. Humor me. I'm not going to ask you for a doctor's note, but say I'm sick as a dog. COVID is always good. Now I have COVID, and you might have three COVID episodes that match each quiz if that's what you need. Now, so if you want to miss a quiz, though, here's what will happen. I'll take the 10% from the quiz and move it to the rest of the class. Let me repeat that again. I'll move it to the rest of the class. Again, to prevent gaming. And here's what I mean by preventing gaming. If I just reweighted everything, if you miss a quiz, you know what's going to happen, right? If you do really well in the first 2 quizzes, you're going to miss the 3rd quiz strategically. Why? Because your first two quizzes, so that's not going to happen. Your quiz will, so the 10% will always move to what's left. So factor that in. But if you take all three quizzes, there's a bonus, which means your worst quiz will not get counted towards your score. I'll reweight all of your other exams and take the worst quiz out. So basically I take the average. So let's, as an extreme example, let's say you get 10, 10, 0, 30. You just completely blew it on the third quiz. I'll throw the third quiz out and give it a 10%, 100% grade, because that's what you got in the remaining exams. So that's like a small bonus for taking all three quizzes. So what I'm trying to say is, take the quizzes, even if you feel a little unsettled. It's better to take a quiz than not take a quiz. But if you really have to miss a quiz, it's not the end of the world. One final point, every quiz and exam I've given in this class, and I mentioned this, I think, in the last class, is on that web page for the class. So you can go check out every quiz. Start with the most recent ones and work back, because there are like 30 quizzes there, and you don't want to be spending all of your time on quiz from 1991. So start at the last quizzes and work back. You have plenty of examples to work through. And that's what the TAs will do in the review sessions. If you're very worried about the mechanics of this class, I would strongly recommend going to the TA session so you can see the problems being worked on. Any questions about the logistics? Now, very simply on the group, you have to find your own group. I'm not going to assign you to groups because I will not be responsible for that action, because then you're going to blame me. As you put me in a bad group. You pick your own group, you live with the group, you police your own group, do whatever you need to do to make sure group members don't, what's the right word, misbehave. Misbehaving here is not showing up. Right? So if you have a group member who doesn't do their work, because you get one grade as a group, you're going to feel the urge to be punitive. And I'd strongly encourage you to watch The Godfather to see if there are any good punitive measures you can use. No, but I'd prefer not to being part of this. I have 800 people in my 3 classes. If I get involved in intra-group dynamics, I'd have to get a therapist for myself. Okay, so the group, you're saying, what happens if I cannot find a group? Because a few of you, many of you are first-year MBAs. You know each other. You might already hate each other. That's fine. You know, create a group that you don't hate. But if you're not part of the first, you don't know people, you might have trouble finding a group. So tomorrow I will create an orphan list. I will send you a link to the orphan list. You can put your name on the orphan list saying, I feel abandoned. Can you adopt me? And if enough people say that, then you can create your own orphan group. So basically it'll be up there. You can send the emails out. Can we create a group of the unwanted, the unwashed, whatever, you know? We can call it the Oliver Twist group. So basically, you'll have to find a group. But before you, as you find a group, start thinking about a company, right? Because in a sense, if you come in with a strong view, you might get the group to go along and say, let's all do this sector. So I want you to start thinking about a company right now, because today's class will already start on that process of the project, because I'm going to start doing things on Disney or Vale, and you're saying, well, maybe I can try that on my company. This is about trying what you learn in this class on a real company in real time. Right? So any final question, any logistical questions? There's a grading pie chart there, but that grading pie chart should not be a surprise, because it's basically the same pie chart that's used in every corporate finance class, which is about 30% A's, 55% B's, 15% C's, etc. Now, I try very hard not to give C's because I know the amount of work. So you have to try to get a C in this class. If you really want to try, go ahead, be my guest. But I'd strongly suggest that if you stay with the class, that that consequence is going to be a very, very low probability. Okay. So let's talk about corporate finance. So as I said, we're going to start on packet 1. So if you get a chance, look at the project packet that is available on the webpage. It lists out every part of the project. The reason I'm not going to go through it is right now, as I go through it, you have no idea what I'm talking about, because I'm describing what we do in week 1 and week 2 and week 3. But the project basically will mirror what we do in class every week. My recommendation, and this is what I will nag you on every Thursday, is that you do your project in real time as you go along, because that's when things are fresh. No, but I know that life will get in the way. You'll fall behind 3 weeks. As long as you keep up, you're going to find that the bulk of the work gets done before you get to week 15. And you write the project report. You don't want to be grinding through numbers in that last week of class. Trust me, that's not the week to be doing it. So that's basically every Thursday. I'm going to say, hey, where are you in the project? So tomorrow's email, you can be prepared. Have you picked a company yet? And next week, I'm going to say, now that you picked a company, and you have to assume that the week one stuck. So every week I will remind you where you have to be on the project. So let's talk about the end game in business. For the next 3 sessions, we're not going to talk about numbers or hurdle rates or models. We're going to talk about what exactly is the end game in a business. You start a business. If you think about what a business is about, if you are pragmatic and you thought about it the Milton Friedman way, the end game for a business is to do what? No, let's not even go there. Is to create a product or service that people will pay for, that you can make money on, right? Sounds so mercenary. And for the longest time, people have pushed back against it. Even Adam Smith in his original, when he wrote the books on this is what capitalism is about, had a very strong moral impulse of saying, but that's not enough. There's got to be a broader mission. And in the last 10 or 15 or 20 years, and this has been going on for a long time, in the last 10 or 15 years, there are 3 critiques you've heard against the end game of, if you're in a business, you have a very simple, pragmatic job. Create a product or service, sell it for the highest price you can, make the most money, and over time, create the most value. And there are 3 critiques. One is that this doesn't create sustainable businesses. I have to tell you, I'm very suspicious of this word sustainable. I'll come back and say terrible things about it, but let's hold off on that. The second is that there are all these other stakeholders. Why aren't you taking care of them? You know what I mean by other stakeholders. There are employees, there are suppliers, there are customers. What's this thing about putting shareholders first? Sounds incredibly selfish. And the third, and this is, of course, the concept of the moment, the acronym to kill all other acronyms, which is there's the E and the S and the G. Why aren't you taking care of those? I call these the theocratic trifecta. You know the reason I use the word theocratic, right? There's an Ayatollah out there saying, I'm going to tell you what the good things to do are, and you got to bring it into business. So let's talk about why we put shareholders first and what happens if we decide to expand the objective. So to do that, let me start with a very simple acceptance that there are multiple stakeholders in a business. Let's make it a publicly traded company. Let's list out all of the different stakeholder groups in a publicly traded company. There are shareholders, right? They supply equity to the company. And what do they receive in return? A residual cash flow if they're lucky, a dividend, whatever's left over. Then there are lenders who lend money to the company and they get interest payments and principal payments. There are employees who work for the company who get paid a wage or a salary, maybe bonuses. There are customers who buy the company's products and services, and they pay a price for them and receive the product or service in return. You might even have suppliers slipping in somewhere in the middle because they supply the inputs to the company and get paid in return. Is society a participant? Absolutely, right? Because this company operates as part of a bigger society, it creates costs for society, they're called externalities, and benefits for society that might not be in the company's numbers. And even your competitors are, in a sense, stakeholders, right? They're stakeholders who want you to fail, but they're stakeholders nevertheless. So there are 6, 7 different stakeholders. Are all their interests convergent? You know what I mean by convergent? They all agree that this is, no, in some cases, they're going to clash with each other. So employees want higher wages, better healthcare. It's got to come from somewhere. Lenders want higher interest payments. It's got to come from somewhere. So let's also accept the fact that stakeholder interests are often going to diverge. They might converge a lot of the time, but they can also diverge. And in corporate finance, and in fact, in all of business, we've historically started with the objective of maximizing the value of the business and very quickly started narrowing that objective. To understand what I mean by this, let me go back to that financial balance sheet I introduced you to last session. Remember, I talked about the business as composed of assets in place and growth assets and funded with equity and debt. When you talk about maximizing the value of the business, you're talking about this side of the balance sheet, maximizing the value of what you've invested in and growth assets. In traditional corporate finance, that is truly the objective. But here's the problem. You have a publicly traded company, it's run by managers, right? Who do managers answer to? Which stakeholder? So we think about getting money from shareholders and lenders. Shareholders are the ones who ultimately have power over managers. So managers say, hey, you know what? We're going to focus on shareholders. Kind of a very, very plebeian reason for focusing on shareholders, because that's who you answer to. And your objective then, instead of being maximizing the value of the business, becomes maximizing shareholder wealth. You see how things get narrowed down. So if you're a manager, your job is to maximize shareholder wealth, right? But how do you measure shareholder wealth? You could call in McKinsey at the end of every year and say, value my shareholder, value my shareholder stake in the company. But there are a lot of assumptions, it's subjective, there's bias in the process, but your company is publicly traded, right? There's a number on your company which might be completely wrong because markets can make mistakes, but there's a market price. Now do you see why the focus in corporate finance, well, it starts at maximizing the value of the firm, goes to maximizing shareholder wealth, and then maximizing stock price. There are problems with maximizing stock price, and I will kind of expose every problem that I can think of. But this is how we ended with maximizing stock price being the objective. But let me step back and talk a little bit about, what that does. It gives you focus in everything you do, right? Because you maximize stock price, what's the only test you ask? If I do this, will my stock price go up? If I borrow more money and buy back stock, will my stock price go up? If I take this project, will my stock price go up? And there are benefits to focusing on share prices. It's instantaneous. You get direct feedback. So when I announce an acquisition, there's the market saying that doesn't make sense. But let's go back and look at why we put shareholders, or all those stakeholders. Why do we put shareholders front and center? First, you can have only one objective in a business. You're saying, why can't I have 6 objectives? If you've ever done operations research, and you want to maximize something, and you want to run something optimally, there's only one objective. There are multiple constraints. You have to decide what your objective is and what your constraints are. You can't, say, I'll have it all. I'll have 6 objectives. So the question is, why should the objective be focused on shareholders? Why not make my objective maximizing employee wealth or maximizing lender protection? Any of those stakeholders, right? So what is it about shareholders that makes them unique or different? Are we just playing games and putting them in front for no reason at all? I described the different stakeholder relationship of the company. Go back and think about the relationships. Every other group here has a contractual claim on the firm. If you're a lender to a firm, nobody forces you to lend, right? In fact, when you lend, what do? You set an interest rate, you write in covenants and protections, and only then do you lend. So you're contractually protected. If you're an employee, you enter into a wage agreement. We can debate whether the protections for employees are strong or weak, whether unions have lost their power and should gain more power. That's a different debate. But this isn't slave labor. Employees work for companies. There's a wage contract. There is a contract. Do consumers have a contract with the company? Again, there are degrees of protection you look for, but if you buy a product or service and it doesn't meet your contractual requirements, you can go to small claims court and sue, or just return the product. Does society have a contract with companies? Well, regulations and laws are the contractual agreement that society has with companies. Again, they might violate them. But society says, you guys create a lot of externality, we're going to charge you a 30% tax rate. You create a lot of, we're going to pass these regulations. Every single stakeholder group outside of shareholders has a contractual claim. What are shareholders left with? Whatever is left over after every, would you ever be an equity investor in a company when I said, you know what, I'll give you whatever's left over, but I'll come to you at the end, but you have no power along the process. Nobody would invest in equity, right? We don't put shareholders first because they're special people. We put shareholders first because they don't have a contractual claim. They have a residual claim. And by focusing on stock price, we are giving up something, because markets can make mistakes, and we'll talk about those mistakes. But the advantage of using stock prices is they're continuously updated. If I use accounting information, I said, look, stock prices are too messy, I'm going to use earnings. Remember, earnings get updated only once every quarter. Markets might make mistakes, but they have no egos. You know what I mean by no egos? Basically, they can change their mind overnight. They say 60 billion off your value. They can love Mark Zuckerberg 4 years ago and hate him now. I am not naive in assuming markets. I don't start with the presumption that markets are efficient, but you can see why stock prices have become this central number. So no matter what people talk about, ultimately, they still look at the stock price. So with that lead in, let's look at the most extreme version of how this plays out. So when people in the ESG space especially talk about corporations, not just in the ESG, a lot of people talk about corporations, it's almost like a throwback to the robber baron age. In the late 1800s in the US, when corporations were first started, there were no constraints. So the Andrew Carnegies and the Rockefellers could basically say, I want to maximize wealth. And because there were no regulations and restrictions on them, or no taxes, they basically couldn't care less about society. There were no unions to protect employees. Employees worked 80 hours, 100. I mean, go back even before them, right? The first factories in London where people worked 20 hours a day, and kids were a part of the workforce. If this is your vision of what corporations are, is a throwback to of course, you're going to get all kinds of costs created for society, because everybody else is going to get screwed. I'm going to argue that there is a version of corporatism where this can happen, especially in markets where there are very few rules and nobody follows the rules. So if this is your vision, put it to the side, think of it as, so I'm going to leave people the choice of multiple visions of corporatism. This is the vision where you've got people running companies, maximizing their wealth, not even all shareholders' wealth, their wealth at the expense of every other group, and there's nothing pushing back. So that's one end. Let me go to the other end. And this other end is also, but before I go to the other end, I also want to deal with 3 critiques of maximizing stock prices that people throw out and act like you should accept them. The first is that if you maximize stock prices, it's somehow incompatible with taking care of your employees. I'll give you a test to run. Over the last decade, take the 20 or 50 companies that went up the most in market value, take the 20 or 50 companies that went down the most in terms of market value. Then ask yourself a question: which group would I have preferred to work in over the last decade? The reality is, in most cases, companies that do well are in a position to take much better care of their employees, right? It's true that you'll always have clashes, but when people talk about, hey, if you maximize stock prices, you must be devastating for your employees.
No, that might be true. I can give you lots of anecdotal evidence on either side, but on average, across the board, companies that do better are in much better, especially in today's day and age where employees get paid with options and restricted stock. A rising tide lifts all boats. The second that you will hear is that maximizing stock prices means you don't care about your customers. Don't let your marketing professor tell you this. This is absolute nonsense. Because maximizing stock prices means you continue selling stuff to your customers, and having dissatisfied customers is not a great pathway to doing this. About 30 years ago, I had to give a talk at this management conference for the Gap. And if you heard of the Gap, now how many of you have shopped at the Gap? Shows you how wide this company's on its pathway to probably nowhere. At one point in time, everybody shopped at the Gap. But but 30 years ago, it was a fast-growing, successful retail company. So it was a management meeting, and Sundance shows you how much money they had to burn through, because Sundance is a very expensive place to be. And they said, can you come in and talk to our management group from a corporate finance standpoint? And I had the singular misfortune of getting on the podium right after the marketing guru. I don't even know who the marketing guru was. He was from Northwestern. He got in and he said, the objective of the Gap should be to maximize customer satisfaction. And I said, that is the stupidest objective I've ever heard. Think about the shopping experience you have at the Gap. You walk in, it's well lighted, it's nice and clean. You're feeling much better about the shopping. You go in, you find the khakis in your right size. You're feeling even better about this. You get ready to leave, and there's something that crimps your satisfaction, right? What do you have to do before you leave, unless you want to be arrested? You got to stop and pay. Those damn cash registers reduce your satisfaction. You see where I'm going, right? If the objective of the Gap is to maximize customer satisfaction, what should they do? Remove the cash registers. Sounds absurd, but that's what happens when you have an absurd objective. Do I want my customers to be satisfied? Absolutely, but maximizing their satisfaction is a senseless objective. Again, while I can give you anecdotal evidence of how some companies increase stock prices by mistreating their customers, the reality is you look across the board, the companies that do the best tend to be companies where customers come back to them. You can say all the terrible things you want about Amazon. But guess what? You want something delivered tomorrow. You're going to go on Amazon. And if you have Amazon Prime, you're definitely going on Amazon, because if things don't work out, what do? You go drop it in the Dropbox, no questions asked, you get your money back. This is the problem that the antitrust people are going to have when they go after an Amazon. Historically, you know what the antitrust people had on their side when they went after monopolies? What did monopolies do? They rip people off. They charge higher prices. What are the antitrust people going to do to Amazon? They say, you're charging too little for Amazon Prime. Okay, that's going to work really well with. This is, I think, the biggest challenge antitrust laws are going to have with the big tech companies. Your problem with them is not that they're charging you too much, it's they're charging you little or nothing. I will leave that debate for another day, because you can say they're getting too big. I don't disagree with you. I am terrified of where we're going to be 20 years from now, because there might be no stores left on the face of the earth, and I'm completely dependent on Amazon, and Amazon sends me an email saying that Amazon Prime membership, which was $129, we've decided to add 3 zeros to it. Where am I going to go? Go ahead.
Clarify why the objective or the filter on the stock price versus, say, the objective being maximizing revenue or maximizing.
We'll talk about that, because it's a good point, because you're picking an intermediate objective. What I want you to think about is, can you conceive of a case where maximizing revenues for a company is actually bad for the company over time? I mean, think of business. Can I do something that increases my revenue? That's the kind of company where consumers can get ripped off, right? Because how do I maximize revenues next year? I go out and sell a lot of crappy stuff, collect my revenues, report 100% jump, but then nobody's coming back next year. So I'm going to argue that when you talk about stock prices, which capture what happens in the long term, and that's where the debate comes. Do stock prices react to short-term earnings or do they reflect long-term value? And that's the advantage of thinking about long-term value as your starting point is there. I'm going to say, look, you can't do things that are good for you in the short term. You know, there's a guy called Martin Shkreli. Heard of him? He started this pharma company. He gave me a moment of notoriety that I did not want. He claimed he watched my webcasts on corporate finance. Terrified me because he got all the wrong lessons. Martin Shkreli, for those you know, created this pharma company, got these drugs that were for diseases that only a small number of people had. And these were drugs that had been 10, 11, 12 years out. And guess what he did the moment after he bought the drugs? He increased the prices 10-fold, 20-fold, 50-fold. And he said, I'm doing this to maximize value. No, that's not maximizing value. It's going to maximize your earnings next year. But if you want to create a business that actually creates value, this is terrible for value. Which brings me to my third critique of corporate finance. And this really pisses me off. You take this class, you go home for Thanksgiving dinner. You're going to sit next to somebody and say, look, I'm taking a corporate finance class. They look at you like you're a moral leper. So what, you're taking a corporate finance class? Because at least in parts of society, the vision is corporate finance, banking, you're a terrible person. In fact, I'll give you a sense of how people view corporate finance. And I'm going to use a movie to illustrate how the rest of the world will view you when you say you're in corporate finance. It's a movie called Other People's Money. I'll send you the link to this movie, one of my favorite movies of all time. It's a movie about a phone cable company. There used to be a time when you used to use phone, before fiber optics, we had to run phone cables to connect. So this company made phone cables. It's a New England company. It had a CEO who's played by Gregory Peck. I want you to file that away. You know, you might be too young to remember Gregory Peck, white hair, distinguished looking. And he ran the company the right way. He thought about his employees and he thought, so he was, and he's targeted in this movie by somebody who is a hostile acquirer. And I'm going to tell you who played the hostile acquirer, and already you will see the stereotyping come into play. Played by Danny DeVito. Right? Basically, you can already see how people have put, so if you're anti-corporate finance, you're Gregory Peck. You care about society, you have white hair, you're distinguished. If you don't care, I mean, if you're in corporate finance, you're Danny DeVito. One of my favorite shows, Always Sunny in Philadelphia. I mean, this is not exactly who you want to aspire to be if you want to be distinguished, right? But the idea is, if you are on the side of caring about shareholders and you're in corporate finance, you must not care about society. Which is a little strange because if you care about society, it means the company is doing something for society, right? I'll tell you I'll give you an anecdote. It has nothing to do with business or corporate finance, but I'll kind of tell you why I think putting these two as being in conflict is wrong. Now, I have 4 kids. My oldest was a very stingy kid as he was growing up. He's become better over time. He's the kind of kid who would not share his stuff. He ate a sandwich, he'd eaten half. And you said, can I give the other half to your brother? He said, no, throw it in the trash. And all my kids have been raised as Catholics. I'm not Catholic, but I know when to stand, when to kneel, I know the entire routine because I've gone to church more often than most Catholics have. And he had his first communion. And I had no idea what this was involved. I didn't realize how lucrative this whole thing could be because he had a first communion party and then people start handing him envelopes, and at the end of the party, he gathers together all the envelopes, and it turns out he has $400 in gifts. Turns to me and he gives me $100. I said, Dad, I'd like you to give this to the poor, as if I'm some direct conduit to the poor, right? But basically, I was shocked. I said, Ryan, you really want to give away $100? That's very generous of you. He said, Dad, I feel rich. And in a sense, it cuts to the heart of when companies can be charitable, right? When you're doing really well, guess what? You're going to be able to spread the wealth. When Microsoft was doing, it gave a computer to every, there was vested interest there. It gave free computers to libraries around the world. When Amazon was doing really well 2 years ago, they created this fund with $500 million for charitable causes. They've kind of decided not to do that anymore because they decided that the charitable causes were really not helping too many people. When companies are doing well, they can afford to spread the wealth around. One of my problems with ESG is, do companies that have high ESG do well, which is the ESG claim, or do companies that do well, are they able to do all the stuff that gives them a high ESG? I'll let you ponder that question, because when companies are doing well, they're far more likely to be able to they have slack, right? They can pay their employees more, they can give back to society. When you're doing badly, you don't have that luxury. If you're Clearview Cinema or AMC, you don't have the luxury of saying, you know what, I'd like to give away free tickets to anybody who wants to come to the movies. You don't have the slack. What I'm saying is, don't make these objectives fight each other. Most of the time they move together. There will be times when you have to choose. And in corporate finance, we are making the choice in favor of what will increase the value of the firm. So let's start with classical corporate finance. I'm going to rip it to shreds, but this is where corporate finance was born 60 years ago. Corporate finance is only 60 years old. It can be traced back to a paper written by Merton Miller and Franco Modigliani in 1958. Pre-1950s, corporate finance was a glorified accounting class. Thank God it's not the 50s anymore. But every corporate finance textbook that you read was born out of this utopian vision of corporate finance. And the utopian vision of corporate finance, and here's how I'm going to structure in terms of relationships. Here's what happens. Managers run the firm, they make decisions. But they do it because shareholders have complete power. They put shareholders' interests first. Shareholders exercise that power through two mechanisms. One is the annual meeting where they get together every year and decide whether to keep you on as a manager. I want you to suspend credibility for the moment, because as I go through these assumptions, your reaction is going to be right. When is the last time you got rid of a CEO at an annual meeting? And the other mechanism that supposedly gives shareholders the power over managers is the board of directors. Remember, the original objective of having a board of directors was to not provide cover for CEOs, but to actually watch over CEOs to make sure that they put shareholder interests first. And because shareholders have so much power over you, you know what you do as a manager? You put their interests first. You're saying, what about lenders? In this utopian world, lenders lend money and they protect themselves fully. They write in covenants and they don't get ripped off. They don't get ripped off even if they leave loopholes the size of a Mack truck. And I could tell you a story why. You have a reputation effect. If you rip off your lenders and you need to borrow from them again, you won't be able to, so you don't take advantage of the loopholes. Again, suspend credibility, right? Third, in this world, managers reveal information about themselves, about the companies they run, to markets honestly and on time. So when terrible things happen to you as a company, you run out of money and say, guys, we need to let you know right away. So I'll give you an example of how this would work out. Now, I've been an Apple user since 1981, which is my first Mac. And for the longest time, as an Apple user, we waited for a laptop to arrive, and it did not come, and it did not come. And finally, in the early 90s, we got this monstrosity called a PowerBook, 15 pounds. So it was just loosely a laptop. And we were happy. Finally, we had our own laptop. It had one small problem. You know what the problem was? It sometimes caught fire. This is not a feature you go looking for in a laptop, right? Spontaneous combustion, not there, not there. Oh, this one has spontaneous combustion. It'll make your next presentation memorable, but your next plane trip could be a disaster. What happened is batteries they were using would heat up to the point of just exploding. So the world that I described, what did Apple do? They'd run out to markets and say, guys, our laptops are hot. That should give you a little bit of a window on how companies shade the truth, right? Technically, Apple's not lying. Their laptops are hot. But when you hear the word laptops are hot, what do you think? They're selling a lot. You don't think of them going up in flames. So let me rephrase it. In the world that I described, they say, guys, our laptops are going up in flames. Our Apple Maps are taking you to a Dunkin' Donuts 4,000 miles away. Did you read about that story when Apple Maps first came out? Somebody put a Dunkin' Donuts in, drove hundreds of miles to Dunkin' Donuts. People like that should not be allowed to have an iPhone in the first place. No. But in this world, you reveal information honestly and on time. Already you can see why this is utopian. And in return, what do markets do? They respond appropriately, rationally. You live in an efficient market. How many of you have done trading for a living before you came back to school? Anybody, any traders here? No? Even if you've never traded, you know what a trading room in this utopian world would look like? Full of intellectual characters sitting around having deep discussions. So an earnings report for Tesla comes out, they gather around and say, let's think about the long-term consequences for cash flows and value. Let's make the best judgment on cash flows for the next 10 years and beyond, adjust the risk, come up with the value. A rational, efficient marketplace. And in this world, there are no social costs, no externalities. Now, there is this vision that some people have that only bad companies create externalities. Every business creates. That hot dog stand outside has caused me to go out of my way at least 12 steps every time I walk by it. Think of the 38 years I've been walking by it, multiplied by the 12 steps every time I walk by it. That's a lot of cost on me. Every business creates side costs. In this world, we've assumed them away. Why? Because that's what the classic economist does with a problem, right? Let's assume the problem away. And the utopian ones, let's assume no externalities. In this world, you can see why it's safe to maximize stock price, right? If you go out and maximize stock price, you're not doing it by ripping off your lenders or creating costs for society or by lying to markets. You're doing it the old-fashioned way by taking good projects and funding them well and providing a product. This is a word where it's safe for CEOs to say, we're going to focus on stock prices and stock prices alone. And all of the other stakeholders will be taken care of because in the process, you're effectively giving them a chance to renegotiate their contracts with you and get the fair rates. So we've got two extremes. You've got the cutthroat corporate world where essentially every stakeholder group is screwed. And then at the other extreme, you have the utopian world, where just go out and maximize stock prices. Be good for not just the company, but for society, for the economy. The truth lies somewhere in the middle. The question is, where in the middle do you want to go between the cutthroat world, where you want to really cut back and restrict corporations, and this utopian world? So let's talk about what can go wrong. Really, what I should say is, let's talk about what cannot go wrong, because everything that can go wrong in this utopian world will. Let's take each of the links. I'm going to start by presenting you with evidence that those two mechanisms I told you shareholders have to keep control over managers, annual meeting and the board of directors, neither works that well. Shareholders, and if they don't work that well in the US, they might not work at all in some parts of the world. And if managers have or shareholders have little power over managers, guess what managers do? They're going to put their interests above. It's not because they're bad people, it's human nature. You're going to put your interests above shareholder interests. So I'm going to start with that link. I'm also going to argue that if lenders lend money to a company and they don't protect themselves, they are going to get ripped off. It's not a question of whether, it's a question of when. And I don't think you need the evidence for this, but we do know that companies are not always honest and not always on time in terms of revealing information. They delay, which is, I think, the more common thing. They delay bad news. And sometimes they skew it. They lie. They commit outright fraud. And the trading room in the real world doesn't look like it's full of intellectual people kind of assessing long-term value. It's full of people who are reacting in the short term to what happened in the last 10 minutes without really thinking through the consequences. Markets are not always efficient. They don't always get it right. And finally, in this world, there are social costs, and some of them can be huge. Think of tobacco companies. Until we discovered, they might have discovered before we did, that tobacco was creating cancer. Everything that can go wrong. This is the world we live in. So what I'm going to do next is going to be strange. I'm going to rip apart traditional corporate finance. I'm going to do a much better job than the people who hate corporate finance. I'm going to expose and the reason I'm going to do it is I want to immunize you. I'm going to give you all of the downside and say, okay, what do we do about it now? And the obvious solutions that are offered don't always work. So let's start with the first of these linkages. In utopian corporate finance, shareholders have complete power over managers. They exercise it by going to annual meetings and getting rid of managers they don't like, and through a board of directors that serves them. In practice, neither mechanism works that well. So let's take each of the mechanisms and talk about why. How many of you own shares in any publicly traded company? Okay, that'll very quickly change over the next year and a half because you probably have to sell the shares to pay your tuition. But for the moment, you're still afloat. How many of you have been to an annual meeting? Well, good. 1, 2, 3. So out of about 100 people who put up their hands, and 3. I own shares in about 50 companies. I've never, ever been to an annual meeting. You know why? Because it doesn't make any economic sense for me to do so. I own shares in Coca-Cola. So to go to an annual meeting, what do I have to do? I have to fly to Atlanta. You know how much it costs to get from New York? They charge, Delta, I think, controls the space. So it's charging me $300 each way, $600 round trip. I get to Atlanta, I have to stay in a hotel in that Peachtree section, dreaded area for me in Atlanta, but you get stuck there, pay $200 a night. For 2 nights, it's $1,000 right there. There goes my profit for the year, right? For most of us, it doesn't make much sense to go to an annual meeting unless you happen to be in the city where the annual meeting is happening, and you walk by it by accident and say, oh, I own shares of the company, let me just go in. Or maybe there's free meals, I don't know. Most people who own shares in a company don't show up at the annual meeting. But even though you don't show up at an annual meeting, there is a way in which you can still be there without being there, right? And these were even true before the days of Zoom. What did you get in the mail, the physical mail, about 6 weeks before the annual meeting, if you're a shareholder in a company that allowed you to be there in absentia? It's called a proxy. This hefty document you'd get from the company. You know what my first reaction when I got that envelope was? If I was feeling environmentally conscious, I'd go into recycling. If I wasn't, going to trash. There's no way I'm opening and reading 25 pages of names of people I had never heard of and said, do you want to vote for that person or not? You know, it's 60% of proxies that get sent to investors goes in the trash. You think, so what? Well, if I own 1,000 shares of Coca-Cola, that's 1,000 votes, right? When I put it in the trash or the recycling, what happens to those 1,000 votes at most companies? Anybody want to try? What should happen if this were a fair world? What should happen if I'm not voting? Those votes should not count, right? But in 99% of companies, those votes get counted as votes for incumbent managers. Votes that don't get returned effectively become votes for incumbent managers. The next time you see a no vote on something in a company, and it comes up with 35%. And Jamie Dimon, CEO of JP Morgan, wanted to become chairman of the board as well. This was about 5-6 years ago. It went in front of the shareholders meeting. And the voting results were reported. 35% said no, 65% said yes. That sounds like the yes one, right? That he should become chair. But my guess is 50% of the votes didn't get returned. 35% no, 15% yes. But because you get incumbent votes as votes for the non-voters as votes for incumbent managers, you're giving them. It's like having an election where the incumbent gets a vote of anybody who doesn't show up to vote. No incumbent in the US would ever lose an election, right? And then once you go to an annual meeting, it's an exquisitely well-planned affair. Right? It's Robert's Rules of Order. You can't get up and raise issues by yourself. And if it's a European annual meeting, it's even, you get good food and good coffee, and it's considered to be bad practice to ask questions of management that might make them uncomfortable. Got good manners. You're a French company. You don't ask, the CEO, why are you having a chateau that you go to every week? Annual meetings are not that effective. We'll talk about what can happen to change the odds. We'll talk about how activist investors have tried to harness the power of proxies in their favor. But as it stands, in most companies, not much happens at an annual meeting. That's going to be unplanned or unscripted. You're saying, what about the institutional investors, though? They should be going to meetings, right? You know what I mean by institutional investors, not just the T. Rowe Price, but the BlackRocks and the Fidelities, which own a lot of shares. They're not like me, where I own 1,000 shares in Coca-Cola. They do go to meetings. They do talk the talk, but they can't walk the walk. You know that most institutional investors who are not activist investors are a very small segment of institutional investors. So activist investors, people like Carl Icahn and Bill Ackman, who run their little funds. The bulk of institutional investors are passive. They vote with incumbent management. If you don't believe me, look at the percentages. I can't get an updated number for this, but more than 90% of the time, institutional investors vote with incumbent management rather than against. Why? Because it's easy. If you're Vanguard, you own shares in 5,000 companies, you don't have the time or the resources to fight the fights, right? So if you truly don't, and Vanguard's probably a bad example because they're an index fund, but if you're T. Rowe Price and you really, really don't like the way Facebook is run, rather than stand and fight Mark Zuckerberg, what's an easier path for you? Sell the shares and move on, vote with your feet. So if you think institutional investors are going to be your ally against managers who are not doing the right thing, think again. So the annual meeting is not a great mechanism for keeping managers in line. So let's talk about the board of directors. Sorry. In theory, as I said, the board of directors is there to protect your interests as shareholders, in theory. But there's a problem. Remember I said I get that proxy from every company I'm an investor in, and they have a list of nominees for the board. There'll be the management's list, and there'll be the sometimes a counter list, but sometimes there's no list. It's like a Russian election, either vote for the guy or vote for the guy, or vote for the lady that was good picked. In basic, there's no choice. But let's think about how CEOs come up with, in most cases, it's a nominating committee in theory that might list the directors. But the CEO, as I say, it's not like you're going to do blindside the CEO. How do you think CEOs come up with names of people to put on the board? I don't know. I'm going to be cynical. As a CEO, you have two choices. You can pick the 9 or 15 people who know the most about your business, will ask you tough questions and keep you on your toes. That's option one. Or you're going to walk into your local country club, into the bar area, and look for the 9 or 15 most slosh people and say, would you like to be on my board? Which one's going to make your life easier? This might be pure coincidence and completely unfair, but when John Mack became CEO of Morgan Stanley, the first 3 people he nominated to the board happened to be members of his country club. I'm sure it's pure coincidence. I would like to see what their alcohol intake was on a weekly basis. But in most boards, you're not getting the best suited people to ask you questions. You're picking people who apply it, who'll go along with what you want. And most directors have at the most a tiny stake in the company. And often the company gives them the shares. They don't even buy the shares. Some companies have raised the ante on this, but you don't have to own shares in a company to be a director in the company, which means you collect more of your money from what you get paid as a director. And remember, in many companies, you get pensions because you're a director than you do for doing your duty. And I'm always amazed when
open up the board of directors for a company and I see two of the directors are CEOs of other companies. How the heck do you pull this off? How can you be the CEO of a company and be a director? Where do you come up with the time? And the answer would be that what happens at a board of directors meeting is really not what you would like to happen, where managers get challenged. First, you have this Robert Rules of Order, very structured, with the chairman of the board. And I'll list that, put that to the side for the moment, kind of laying the agenda. Now, there's this big push to be a team player. Why? Because you want to get to lunch, you want to leave. Yeah. And finally, about 20 years ago, there was this big push in the US to make directors independent. That's good, right? Because you don't want to have your cousin as a director. You don't want to have somebody from the company as a director. Sarbanes-Oxley basically pushed for independent boards, and people thought that this was a solution. That if you had independent directors, that they would do the job of asking the CEO the right questions. Let me ask you a question. Can you be an independent, ineffective board? The Lehman board passed every Sarbanes-Oxley rule for being a board. 2008 didn't ask the right questions. And that's always puzzled people. They're independent. Why didn't they ask the right questions? In psychology, there is this whole body of research about authority figures. How when you're part of a group and there's an authority figure, you tend to bend to that authority figure. You become the board, you get put on the board of directors for Coca-Cola. You walk in there, you sit around the board. There are all these distinguished people around the table. And the CEO of Coca-Cola walks in to talk about a deal they're making to expand wherever in the world, or expand a particular beverage. Who knows the most about Coca-Cola in that room? Obviously, the CEO does. He or she spends all of their life around Coca-Cola. That's the authority figure issue, which is you feel intimidated to ask questions because that person must know more than I do. So when they say this is a good deal, I'm going to kind of hold back because I could look stupid if I ask them. We've created independent boards, but we haven't created effective boards. So I'm going to apply this test to Disney. And I'm going to go back in time. One of the nice things for me for Disney is I've been using Disney in my applied corporate finance classes as an evolving company starting in the 1990s. When I started in the 1990s, Disney was run by a guy called Michael Eisner, a man with an ego so large that he could be in a large room by himself, but it felt crowded. He was an imperial CEO. You know what imperial CEOs do? Like Caesars. They make decisions and people go along. And this was the board of directors he had created at Disney in 1997. So I'm going to go through the list, the why. I think this is perhaps the worst board of directors ever created at a large publicly traded company in the US. That's quite a contest to win. Right? Remember, Enron is up there. And I'll tell you what I don't like about this board. First, there are 17 people on the board. Saying, so what? It's an experiment I want you to run. After class today, get together as a group of 17 and decide where to go for lunch. I will make a prediction. You will not eat today. Groups of 17, by the time you get around the table, people talk. There's no real time. It's too big a board. In fact, research consistently indicates that 9 or 10 is about the right number. What Enron did, not only they have 26 people on the board, they made sure half of them are in time zones that were so different that they have zero chance of actually being either awake or at the meeting. So that's a first strike against the board. Too many people. Second, 8 of the 17 members were insiders, either people who worked at Disney, used to work for Disney. This was before Sarbanes-Oxley. You could do whatever you wanted. Strike 2. Strike 3, who's the chairman of the board? Oh, it's Mr. Eisner. So remind me again what the job of the board is, to ask tough questions to the CEO. So you chaired the board that is supposed to ask yourself tough questions. How does that work out? I've never understood how you can be the chairman of the board and the CEO at the same time. It seems like an obvious conflict of interest.
It used to be almost standard in the US. Now it's less standard, especially because investors have pushed back. That I'm chairman. Now, if this were baseball, you just struck out, right? But this is such a bad board, I'll give them a 4th strike. Let's look at some of the outsiders. Maybe they make up for all the rest of the faults of the board. Let's go down the list. Rebecca Bowers, head of school, Center for Early Education. This might be pure coincidence, but Ms. Bowers was the principal of the elementary school that Michael Eisner's kids went to. I'm sure it's pure coincidence. File that away, right? Let's keep going down the list. Roy Disney. He's there because his grandfather owned shares of his father. Basically, it's inheritance. We'll talk about what Roy did in the years following, because he actually played a very strange role in the unraveling of Michael Eisner. There's George Mitchell. What was he doing? Probably checking for steroids on the board. No, if you don't know what I'm talking about, he actually was in charge of the group that looked at steroids in baseball. So I'm just kidding. So no, I'm sure there are no steroids on this board. Father Leo O'Donovan. Anybody go to Georgetown undergraduate? No, no, you did no. I'm sure he's a very good man, but again, this might be pure coincidence. But Michael Eisner's son went to Georgetown. He served on Georgetown. But Eisner served on Georgetown. He made a big donation to Georgetown. I'm sure there was no quid quo pro, but it doesn't pass the smell test, right? And here's my favorite example of conflict of interest: Irwin E. Russell, attorney at law. You say, what do you have against lawyers? Actually, plenty, but this is not the forum to talk about it. But he was Michael Eisner's personal attorney. How the hell do you get away with this? I'm going to get my lawyer on the board. He's going to be an independent. It's nice to have your lawyer in the room. Tell you, don't answer that question, Mike. Take the 5th on that one, Mike. But don't tell me he's going to be an independent director. And what about Sidney Poitier, great actor? You know what? He made the list of top 10 directors in 1997. You think this is good. Somebody's doing something right. He made the list of directors who missed the most meetings in 1997. Guess who's coming to dinner? Guess who's not coming to the meeting this time? And he headed the compensation committee. It's nice to have a director who doesn't show up at the meetings and decides how much to pay you. This is a bad board. It's a rubber stamp board. Remember, I described Eisner as an imperial CEO. This is a board that when Eisner says jump, says how high. In fact, when you look at this board, it should answer the question as to, because at the time that I looked at this, CalPERS is the California Pension Fund, one of the largest institutional investment funds in the US. At that time, it was one of the few institutional investors that was activist, that was asking questions of managers. In fact, there had 3 questions. Majority of the directors outsiders, the chairman of the board independent. Disney was the only S&P 500 company that failed all 3 tests when they asked this. In fact, piling on, Business Week ranked Disney in the late 90s as the worst board at the time out of the 500 companies. But it's not an accident, right? It was created by design. And it can explain some of the really strange things that happened at Disney in the 1990s. I'll give you an example. Michael Eisner came to Disney in 1986 from Paramount. At that time, Paramount was riding high. Disney was actually a company that had crashed and burned. Right? Walt Disney died in the late 60s, but Disney kept with the animated. Nobody was watching The Fox and the Hound and all the movies that came out in the 70s. And they decided they were going to hire Michael Eisner, fresh blood. And Michael Eisner didn't want to leave Paramount, successful company for this unsuccessful company. And he extracted a price. He said, if you want me to come along, in addition to paying me whatever I ask, you have to let me bring my personal assistant along with me. You see, what's the big deal with a personal assistant? Remember the days before iPhone calendars and contacts? Your personal assistant ran your life. They told you where you lived, what your wife's name was, when her birthday was, basically, or your spouse's name. Basically, they did everything for you. He said, I need that person next to me. And Disney said, okay. And he said, not only do I need that person, I want to make him whatever I want, wherever I put him in the firm. His personal assistant was a man called Jeffrey Katzenberg. So Eisner comes into Disney with Jeffrey Katzenberg, and show you how Eisner thinks. He puts Katzenberg on, as the head of animated movies. You know why I put him as the head of animated movies? He was convinced that this division was going to crash and burn. And he said, you be the head of that. You can crash and burn with it. And Katzenberg comes in and he becomes the head of animated movies. And the rest, as they say, is cultural history. You get Little Mermaid, Lion King. And to show you how little chance Eisner attached to this, he also promised Katzenberg that he could make 5% of the revenues or income on the movie in perpetuity, or whatever movies. Can you imagine collecting 5% every time the sea witch sings? You don't have to work a day in your life, right? Jeffrey Katzenberg succeeded beyond anybody's wildest dreams. He made animated movies a huge success. Now, let me ask you a question. If this was a business class, you brought in somebody, they've turned this division around, made it a success, what should he do to them? Move them up the ranks, give them more. That thought never crossed Eisner's mind. His concern was, this guy is getting too successful. He might be a threat to my power. So he goes to the board and says, I want to fire him. Man, you're the board of directors of a company. Here's the CEO saying you want to fire the divisional head of perhaps most successful division of Disney, accounting for 50% of the profits. I think you'd push back, right? But this is the board we're talking about. A board without a spine. They said, okay, that's what you want. And then one of the board members, perhaps one with a little semblance of a spine left, says, but haven't you promised this guy 5% of the profits on these movies in perpetuity? Eisner says, don't pay him. What do you mean? It's a contract. Don't pay him. Why? I don't like the guy. Now, do you think this is a good contractual reason for? No, so Jeffrey Katzenberg sued. He got $150 million from Disney, which he used as seed money to start DreamWorks. If you watch the Shrek movies, notice all the digs they get in at the Disney movies. Sleeping Beauty has an addiction problem. That's why she sleeps all the time. Snow White is some kind of, hangs out with 7 perverts in a hut. You're wondering why there is this internal, what is this against Disney? It's that history coming out to play. So in the 90s, things would happen at Disney and the Wall Street Journal would run this article of, why doesn't the board ask questions? And the reaction was, have you looked at who sits on the board? So the next time you have questions about why is this company doing what it is? You might want to look at who's on the board of directors of the company. It's going to tell you a lot more about everything that this company does than poring over the financials and computing every accounting ratio known to man. So I'm going to leave you with a page. So this requires that you pick a company first. So after you pick a company, you can pick a random company for the moment, if nothing else. Go look at the board of directors. And I'll send you a couple of documents you can use to get the background on who's in the board of directors. It's actually required to be filed. And you can start looking at, is this the kind of company where the board of directors actually has some say, or is this just a rubber stamp board?